Hi, I'm Vikram Malhotra, one of Mizuho's real estate analysts. We recently initiated on Prologis with a buy rating and a $140 price target. Prologis, as many of you know, is the world's largest logistics landlord that owns or manages over 1 billion square feet of warehouse space. We also upgraded East Group to a buy with a $185 target. We think the setup overall for industrial REITs is positive, with still strong fundamentals, attractive valuation, and REITs that have low-levered balance sheets and well-covered dividends. So what differentiates Mizuho's work is really the granularity of analysis. For any real estate owner, location, location, location are three magical words. But we think micro-locations in industrials will be very relevant in 2023, based on our new deep dive of over 300 industrial submarkets in the US. The sneak peek into the methodology is really that for each of the submarkets, we assigned a weight based on the revenue contribution to each REIT in our coverage. We then use the fundamental data from CoStar to analyze demand relative to available stock, vacancy trends during and pre-COVID, new supply levels, and finally, market rent growth. At a high level, the work suggests there is a tale of two cities developing this year. There's greater dispersion in fundamentals that's occurring in demand and rents of warehouse. But the debate is just not choosing between coastal versus non-coastal REITs, but really thinking about intercoastal variations. The dispersion in fundamentals is very relevant today, given REITs such as Prologis are very diverse, but other REITs have a much more narrower focus. So let's get into some numbers. First of all, the COVID pull forward in demand is normalizing. Nationwide demand today is about 8.2% of supply, down from a peak of 11% that we saw during COVID. But this is still much higher than numbers we observed pre-COVID. Second, historically the dispersion has not been this wide. The top cohort is seeing 10+% demand and accelerating rent growth. The bottom cohort is seeing 4% demand and decelerating rent growth. Now we think this is occurring for a combination of three things. First, macro headwinds, possibly slowing port activity. Second, excess supply in certain markets. And third, what we're calling demand fatigue for some tenants. Now what really surprised us is the magnitude of demand deceleration in certain coastal locations. For example, several of California's submarkets saw 20+% demand during early 2022, but this has fallen sharply to the mid-single digits. So the way we would play this dispersion is two ways. First, we would avoid exposure to REITs with a narrow geographic focus where rent growth has spiked. Second, instead, we'd play geographically diverse REITs that have steadier market rent growth, but also development lease-up opportunities. In fact, the two top picks of Prologis and East Group we think are actually fairly defensive in nature. Now on Torino, we're neutral weight. The submarkets are strong, but the REIT is over-indexed to rent growth continuing in 2023 and 2024. It is also a consensus long. We like Prologis because it's a core holding for many, but we also think the levers are underappreciated. Finally, East Group is actually an out-of-consensus buy call. We think the submarkets are much more resilient than perceived. Thanks so much for listening. If you have any more questions, feel free to get in touch with me, vikram.malhotra@mizuhogroup.com.